In this episode, I will explain ICT mitigation blocks. I will break down how they form, how you can identify them on the chart, and how to use them to frame your entries. So let's get straight into it. First, we're going to hop into the PDF and go over what a mitigation block is, and then we'll look at a few examples on the chart. So let's get into it. Here we are in the PDF, and this diagram shows what a mitigation block looks like within a smart money reversal. Now, the first question is, how does this differ from a breaker block? You can see that with a mitigation block, price forms a low, then a high, then a higher low, and then eventually a higher high. That structure is different from what we see in a breaker block. With a breaker block, price would typically form a low, then a high, then a lower low, and finally a higher high. That difference in structure is what separates a mitigation block from a breaker block. Now let's hop into an example on the chart. Here we are on GBPUSD on the 60-minute chart. If you've watched my previous videos and were wondering about the time frame, it is usually displayed down here in the center of the screen. Now let's walk through this example step by step. As price develops, what we're looking for first is a failure swing. In the case of a breaker block, we would typically need price to sweep this high here. That would give us a structure of high, low, higher high, and then lower low. But with a mitigation block, we don't necessarily need to sweep that high. Instead, all we need to see is a lower low forming. That gives us a structure of high, low, lower high, and lower low. And as you can see here, price does exactly that. It forms the lower low. At that point, I can mark out this down close candle and extend it forward. This candle becomes the potential mitigation block. Now this example is slightly higher probability because the mitigation block is overlapping with a fair value gap, which adds another layer of confluence. So let's see what happens next. Price comes back, retests the fair value gap and the mitigation block, and then continues moving lower. Now if you keep watching the structure, you'll notice something interesting. We actually get another mitigation block forming, because we once again have a high, low, lower high, and lower low. So we can mark out this candle as well and extend it forward to see how price reacts. If you notice here, we do have another fair value gap, but price eventually closes above it, which tells us that this setup is starting to fail. Now the reason I personally don't prefer trading mitigation blocks like this is because no highs were swept during this move. Since no liquidity above the highs was taken, what price is doing instead is creating multiple failure swings at the highs. These failure swings become liquidity targets for the market. So if price is going to reverse, it will usually have no problem moving through this entire area, because all of those highs represent resting liquidity. And as you can see, price eventually moves strongly through that area. So that is the main reason why I personally don't prefer trading mitigation blocks in this way. However, there are certain situations where I do consider trading mitigation blocks, and I'll show you an example of that next. So let's hop back into the PDF. So the one situation where I will consider trading mitigation blocks is when we have SMT at the low. What that means is that another instrument forms a breaker structure, and because of that divergence, price should not be coming back to take that low again. Let's go through an example to make this clearer. Here we are looking at YM, and just to give some context, we are currently inside an hourly fair value gap. Now if we drop down to the 5-minute chart, you can see that price first puts in a high and then begins to move higher. But instead of continuing cleanly higher, price forms a failure swing and then starts to move lower. Now the question is, why would I consider trading this mitigation block when earlier I said that I generally do not prefer trading them? The reason is because of SMT. If we take a look at NQ, which I'll show on the screen, you can see that NQ actually makes a higher high relative to this high, while YM does not. That creates an SMT divergence between the two instruments. Because of that SMT signal, I now have additional context that gives me more confidence in this setup. So what I do is mark out the down close candle that occurs before this failure swing. That candle becomes my mitigation block. I then extend that level forward to see how price reacts when it comes back to it. Now technically, since price closed below the mitigation block, I could take an entry on the first retest of the mitigation block. Another option is to simply wait for a second retest for more confirmation. If you watch how price behaves here, you can see that when price first comes back to the mitigation block, we get a reaction and price moves lower. Later on, when price comes back again to retest the same level, we once again get another reaction from that mitigation block. So this is an example of a situation where I would actually consider using a mitigation block, and the main reason for that is the presence of SMT divergence. Because the other asset already took the high, I have more confidence that this level will hold. At the same time, the price action here also creates a nice liquidity pool above these highs, which eventually becomes a future target. And as you can see later in the chart, when price eventually returns to this area, that liquidity becomes the target for price. Now let's hop into a few examples of spotting and dragging out mitigation blocks on the chart. Here we are on gold on the 4-hour chart, and right now we have a weekly fair value gap, which is acting as our higher time frame point of interest. So the first thing we want to see is whether we get a smart money reversal from this area. As we move forward, you can see that we start to form a market structure shift. Now, if you don't like using this particular high for confirmation, you can always wait for this next high to be broken as well, which would give you a stronger confirmation. Continuing forward, we then see a fair value gap form, so we'll go ahead and mark that out on the chart. After that, price reacts from the fair value gap and begins to displace higher. Now the next thing I'm looking for is exactly what we discussed in the PDF. I want to identify the sell side of the curve and start dragging those levels forward. Specifically, I'm looking for order blocks on that side of the curve. If you notice here, we have two up-close candles that move into an important level, and then price goes on to make a new low. That tells us that this area originally acted as a bearish order block, but now price has displaced and closed above that level, which means that the old order block has been disrespected. Because of that, I would expect price to reaccumulate inside that area before continuing higher. So we go ahead and mark that level out as a mitigation block. Now let's identify another one. You can see here we have another up-close candle, which could also act as a potential mitigation block. Let's see how price reacts when it returns to that area. As price retraces, you can see that we get reaccumulation inside that mitigation block, and then price displaces higher again. Now at this point, my next point of interest becomes this mitigation block right here. At the same time, we also have a fair value gap sitting in the discount of the range, which adds additional confluence. As price continues, you can see that price reaches into the mitigation block and then once again continues moving higher. Another thing you might notice is that this area right here could also be considered another mitigation block because it follows the same structure. And once price reacts from that level, we continue moving higher and eventually take out the original consolidation highs that we marked earlier. So this example shows a buy scenario where we used old bearish order blocks. Once price disrespected those PD arrays, we dragged those levels forward as mitigation blocks and then looked for reaccumulation inside those areas before price continued higher. Now let's hop into another example. All right, so that is how you can identify and use mitigation blocks in your trading. The key thing to understand is that mitigation blocks come from old order blocks that price has already disrespected. Once price closes through those levels, they often become areas where price can return, rebalance, and then continue in the direction of the move. So instead of looking at them as traditional order blocks, we are simply dragging those levels forward and watching how price reacts when it comes back into them. Just remember that mitigation blocks work best when they are combined with higher time frame points of interest, fair value gaps, or other PD arrays, because that gives the setup more context and increases the probability of the reaction. If you found this video helpful, make sure you like the video, subscribe to the channel, and share it with someone who is trying to understand market structure and PD arrays better. If you want to connect with me, you can join my Telegram and Discord. The links are in the description. And if you want to learn directly from me, you can check out the mentorship link below. I will see you in the next one.